Welcome, everybody. Thank you for joining us at the Conservation Finance Alliance webinar series. We're really excited to have Zach Knight here giving us a presentation today, but let me just give you a quick reminder of about the CFA and the webinar series. We have CFA is organized to try to improve awareness, knowledge, and innovation around conservation finance globally. And we are, as most of you probably know, sort of member-based organization with strong partnerships with all the large actors in the space. And we are have quite a lot of initiatives going on. The webinar series being one of them. And we're really thrilled that you could join us for this. So we have an upcoming webinar. I thought I'd let you know. Also, please, if you're on, please mute your microphones, because this is a webinar forum where you'll be able to ask questions later on. So we can keep your microphones active, so it's up to you to mute them. Just to let you know, we have Robert Weary from the Nature Conservancy, who's going to give the next webinar coming up just in a few weeks on May 24th, and that's going to be entitled Financing Ocean Conservation via Debt Conversions. And Rob's in the process of launching quite an ambitious program. And I would highly recommend that you come and join us for that webinar. That's going to be at 10 a.m. Eastern on the 24th of May. And today we have Zach Knight, who's the co-founder and managing partner of Blue Forest Conservation, which is a very innovative environmental finance firm that's looking to leverage financial innovation and develop sustainable solutions for environmental challenges. And Zach has a career in finance with Merrill Lynch before, and designing and working on high yield and distressed corporate bonds and things like that before taking an MBA at Berkeley's Haas School. And we're really excited to have Zach present about this innovative instrument that's been launched here in the U.S. And so without further ado, over to you, Zach.
Thanks so much, David. And thanks to everybody else for joining and your interest in Blue Forest Conservation and the Forest Resilience Bond. Thanks for the kind intro there. So for a little bit of background for folks, Blue Forest Conservation is just over 4 years old. We operate both a benefit LLC and a nonprofit entity, and we've been entirely philanthropically supported from day one. And that's coming from groups like the Rockefeller Foundation and their innovative finance portfolio, but also the Gordon and Betty Moore Foundation and federal agencies in the US like the Department of Agriculture and the EPA. And what that's allowed us to do is really focus on one thing and one thing only, and that's the Forest Resilience Bond. So in partnership with the US Forest Service and the World Resources Institute, we've developed the Forest Resilience Bond, which at its core is a public-private partnership that allows private capital from groups like insurers and pension plans to come in and cover the upfront costs of doing much-needed forest restoration across the Western US, with a primary goal of reducing the risk of catastrophic wildfire. We then allow all the beneficiaries of this work, so perhaps the US Forest Service, but also water and electric utilities, flood control districts, state agencies, and even private companies, to enter into contracts based on the benefits that they receive. And it's all of those contracts put together that ultimately pay our investors back with a modest rate of return. So that's a high-level introduction to the Forest Resilience Bond. And in this webinar, I'm going to take the first few minutes here to actually talk about the forest health issues in the Western US. Then I'm going to describe how the Forest Resilience Bond came together and why we think private capital is important. And then the last part of it will actually be an overview of our first pilot transaction that launched in the Tahoe National Forest late last year. So I always like to start with a few pictures here. This is a picture from Belden, California. Don't worry if you don't know what that is. I think it's a town of less than 100. But this is smack dab in the middle of the Palomas National Forest, which is just a little bit north of the Tahoe National Forest. And the river system here is the North Fork of the Feather River. It's an incredibly important river system here in California. It's known as the Stairway of Power. We get about a third of our hydropower generation from this river system. And the picture here is really designed to show you what a forest looked like at natural density. This is before we saw a lot of mining and logging operations. It's obviously before any of the hydropower was put in. This is the late 1800s. And then fast forward to the late 1900s. And the change in density is really staggering. I'll put these pictures side by side in just a moment. But what you see here is a forest that has 10 to 15 times as many trees as would be naturally occurring, in large part due to 70 to 100 years of full-on fire suppression. So the Sierra Nevada range is an area that typically has a fire return interval of 10 to say 30 years. And as European management practices took over, we looked at these trees and said, hey, this is what the West was built on here. These are taxpayer assets. We need to protect these trees at all costs. And doing that, the Forest Service instituted the 10 a.m. rule, which meant that every fire had to be put out by 10 a.m. the next day, which is why we see density like this. So when you look at these two things side by side, and this was a great effort actually by a Forest Service photographer who went to recreate these historic photos to show the change in abundance across our national forests over the course of the last 100 years. And it's this overgrowth of this density, when combined with an increasingly hotter and drier climate, that creates tinderbox conditions. And the results are really unfortunate. I mean, if you look at 2018, it was the deadliest wildfire season in California history. If you look at 2017, it was the most expensive fire season in US history. Going back to 2016, we had some of the worst air quality issues from Denver to Seattle. And in 2015, it was actually the most acres burned in United States history. So I hate to say it that unfortunately, this is not an anomaly and this is a trend, but there's good news. There's actually a well understood solution to this problem, and it's called forest restoration. And as the name implies, the goal here is to restore the forest to full ecological function. And when you look at these two pictures, I think there's really a staggering difference. I was actually not the one taking the picture in the overgrown forest, but I was there. That's the Stanislaus Tuolumne Experimental Forest in the Stanislaus National Forest in California. And when you're looking at this, you can't even see 50 feet in front of you. It really is an incredible thing. And it's all those small trees, younger trees, that actually act as something called ladder fuels, meaning that if a natural fire did start on the ground, our large trees, the trees that we want to be in there and be a part of the watershed, they naturally would be able to push off some of this low intensity fire. But what happens with these smaller trees is that the fire uses those trees as a ladder, hence ladder fuel, to get all the way up to the canopy, and you go from a healthy low intensity fire, which again is natural in this setting, to a crown fire that becomes much more devastating to habitat, species, everything else, also human populations. But they're also much more costly to put out, and you run the risk of completely losing control of the situation. On the left side of the screen, you see a forest where some thinning has taken place. You get a little bit of heterogeneity in terms of species and spacing and age of trees in that system. And this is one where there was actually a prescribed fire done the year before, which really, again, was used to clear out the forest floor. So again, I'll talk a little bit more about the treatments that come. Every ecosystem is different. In fact, the Forest Service has plans for each forest. They have general technical reports that tell you how to restore a forest back to historical density and to restore ecological function. And all of this is based on the best and the latest science. So we've talked quite a bit about fire, but I think it's important to acknowledge some of the other benefits of a healthy watershed. I think what really jumps out at people first and foremost is, or should be, the connection to water. So in the state of California, we get over 60% of our developed water supply from snowpack in the Sierra. We ask our water utilities and electric utilities to some extent to manage these systems and to make sure that we have power on demand, that we have water on demand. But at the end of the day, often these utilities don't own these watersheds. It's not their land. It's not their land to manage. Usually it's federal land. It can be state land in other lands, in other states as well. We don't have too much state land here in California, but there's a tremendous amount of downside risk that these land managers and these utilities would really like to try to get rid of by doing this restoration project. So if we don't have a healthy ecosystem and we have these large damaging fires, you can see sedimentation events. You can see lots of post-fire flooding, which can be incredibly destructive. And then on the fire side, you also see a tremendous amount of carbon emissions. And this is really a shocking thing. We had a report come out last year in California that said our forests, which are in theory one of our best carbon sinks, are actually on the verge of becoming net emitters of carbon because wildfire season has been so severe. I'm going to say that again just for emphasis. We are on the verge of our forests in California being net emitters of carbon. It is a really crazy thing when you think about it from that perspective. And then the social side, I feel like that gets missed a lot here. It's often economically disadvantaged communities that are disproportionately impacted by fire. And those are communities where in California, we might have an unemployment rate of, let's say, 2.8, 2.9%. But in some of these rural areas, it can often be a lot closer to 10 or 15%. So if we can protect some of these communities while also creating jobs in a sustainable way, that can really add to community resilience in these places. And I think that's something that caught us off guard. We looked at this really from an environmental standpoint and have learned a lot more about the social issues and why people may want to support these projects from that perspective. So this looks like a scary slide, but it does give me some hope, and I'll tell you why in just a moment here. So when you look at how the Forest Service spends its money over the years, and you go back to 1995, you see that they spent about 16% of their budget, 16%, fighting fire suppression. Fast forward to 2017, which is the last year I've seen numbers on, it was 56% or $2.7 billion just on fire suppression. So that's just to put out the fire. That's not to fix the damage on the aftermath of the fire. It's not the economic damage that's done by the fire. It's not the insurance claims. It's just the firefighting costs, which again is quite staggering. And since then, they've actually had to revise upwards when they think they'll hit 2/3 of their budget. It's not going to be 2025. It's going to be in 2 short years in 2021. And I think this quote at the top really says it perfectly. We're right now in a vicious cycle where the Forest Service is forced to pay for today's fires out of the funds designed to prevent tomorrow's. And it's a great example of an ounce of prevention could really be worth a pound of cure in this setting. And I said at the beginning of the slide that it gives me hope, and here's why. At this point, it's not really a science question anymore. You can see it's really more of a finance problem. And to me, that's a problem that we can solve. So I'm excited about that. So introducing the Forest Resilience Fund, and before we talk about the goals, I think it's really important to touch on the governance of an instrument like this. There was a lot of discomfort in the early days between state actors and federal actors with respect to the Forest Resilience Fund and having private investors involved. So we said to them that we really want to do 2 things to help solve that. And this got us to a point where everybody was really comfortable. The first was to make sure investors are not engaged until after the project has been planned. In the United States, we have to go through the NEPA process, National Environmental Policy Act. And in California, we also have the CEQA process as well, similar, but at the state level. And investors don't have any say as to the prescription of the treatment or where the projects are taking place. So that was one end of it. We want to make sure that was designed by the land managers for the ecological benefit of these projects. And then in terms of who actually does the work on the land, we also pass the funding through a nonprofit entity that is our project manager that hires the contractors. They hire local folks, the folks that will do the best job, and they don't try to squeeze out a couple extra pennies to get a better return to the investors. The structure just does not work like that. So those were the 2 biggest concerns, and you'll see as I take you through a roadmap here, how those firewalls from a governance standpoint are put in place. And I'm stressing that because if anybody out in the audience here is going to be working with government at many different levels and private investors, governance is always going to be an issue. So back to the goals here. So what we really want to do is provide resources to the groups call themselves often here in California and across the West forest collaboratives. And they're groups that have come together that could include the Forest Service, utilities, homeowners associations, handful of other groups like that have the social license to actually implement these projects. They have community support for them. And what we say is, we'd like to provide you the resources to implement the projects that you already want to do. Again, because we represent investors, we don't want to dictate what happens on the landscape. We want to give high capacity groups the resources they need to get to our second goal, which is accelerating the pace and scale of these restoration activities to reduce the risk of catastrophic wildfire. And the last piece, and I think it's particularly relevant for this webinar, is that there have been very few, if any, other opportunities where private investors can make an investment that actually earns a return while supporting public land management. And I think in a lot of ways, that's one of the coolest elements of this project. And there's been a tremendous amount of demand for investors in our first project, and we expect that to continue to do exactly that. So on the earlier slides, I did touch on the social and environmental benefits. I do want to talk about the financial side just for a second. These are projects that have an enormous payoff period in terms of the economic value that they create. They're just not happening because it's tough to get all the beneficiaries on board, or we just don't have enough public funding to do some of this work. But if we can get these projects done, there are taxpayer and ratepayer savings to be had. And then from an investor perspective, this is something that really isn't going to correlate with the stock market, the bond market, the commodity market. So it's a nice diversification play with a relatively uncorrelated asset. So how do we do this? The biggest challenge was really setting up the forest resilience bond ecosystem. And if you look at the left side of the slide, you see the beneficiaries, research partners, community groups, so on and so forth. What we realized was groups like the Forest Service, you know, the largest forestry research organization in the world, but many of the other beneficiaries there, stakeholders, were not connecting with all these groups. And even if you were connected with all these groups, nobody was talking to investors. And on the next slide, I'll talk about why that's important. The other thing we realized is that people don't really speak the same language. So it felt like it was our job to try to get into the middle of that, help translate, help better understand the needs, and bring everybody together on the same page. On the right-hand side, you can see some of our project partners. On the research partners, Stanford here in the UC system. And I'm calling that out because that's one of the elements of this that really has to be geographically specific. We ask our partners at the Forest Service, at the utilities, at the other entities that are stakeholders, who do you want to work with from a research standpoint? Because again, and you'll see this later in the presentation, measuring the ecosystem service benefits of these projects in a credible way is paramount to building stakeholder support and actually getting them to put money into these projects. The last piece here on the grant in-kind funders, we mentioned the grant funders, but I want to highlight the two law firms that have been doing pro bono legal work for us for the last 4 years to the tune of about $1.5 million, I would guess now. And you'll see this is somewhat complicated, and we really could not have done it without the support of Brownstein Hyatt and the folks from ORC, who've been just fantastic. So this is kind of the why, and this is a big eye-opener for folks that we work with in the federal and state government. I'm sure it'll be less eye-opening to all of you on the webinar, and you're probably very familiar with the report that I'm about to quote here, but there was a report from Forest Trends, Nature Conservancy, Encourage Capital, that surveyed conservation finance practitioners, and they found that each year on average, there was about $3.1 billion sitting on the sidelines looking for conservation finance opportunities, but they could not find anything to invest their money in. And I think it was largely for a couple of reasons, namely risk return profile was not great for these projects, and there were not many established managers, which again, not too surprising, this is still a relatively new space. But that's an important amount of money because when you compare that to what the Forest Service was able to spend on proactive restoration in 2017, you get a sense of the opportunity. And then when you compare that to the right side of the slide that talks about the total need for restoration, which the Forest Service has recently updated to $80 to $100 billion, you look at that and you see if the Forest Service was going to do this on their own and the forest stopped growing and we stopped having fires, it would take them about 200 years to address this issue. And it really drives home that point that public and philanthropic funding are not enough. So I'd like to talk about the advantages of private capital. I'll keep it relatively short here because I'm guessing most folks are on board. But the first is cost sharing. So often when these Forest Service projects start, there's a very limited amount of the budget that's actually spoken for, that's actually been raised to start implementing the project because it's done on one-year budget cycles. What we do in this model is actually bring all the stakeholders together and we raise all the money at the outset of the project so you know exactly when things can be implemented throughout, and there's a lot more transparency, accountability, and projects just get done more quickly. Second piece is, we're doing about 500,000 acres a year. That's sort of a goal here in California. We've got 20+ million acres that are in need of restoration here in the state. So we need to start doing larger projects. And there's some benefits to doing larger projects. We'll start to achieve economies of scale, but perhaps even more interestingly, we can start to develop the restoration economy, which means folks that will work in the woods, especially in these areas with really high rural unemployment. And there's a variety of skill that's required for this. If you want to be a chainsaw operator, it's a short certification. If you want to operate heavy machinery, maybe it's 6 months plus an apprenticeship. If you want to be a burn boss and really work on prescribed fire, you're going to need 3 to 5 years, if not more, training for something like that. So a wide degree of skill needed to implement these projects. And then also, what do we do with some of the wood that comes off the forest? Is there another industry where we could turn that into press board or into energy or something like that? And the last piece of this I think is really important are the ex post payments. And what that means simply is that for risk averse stakeholders like utilities, for instance, we allow them to pay for the benefits after they're received. And that can only happen if you have an upfront investor that's paying for the treatment costs. And that's a great way to transfer risk from that utility to investors that are much more likely to want to take that risk and then also be compensated for taking that risk. So we asked ourselves with the Forest Resilience Bond a pretty simple question, which was why, if we have all this investor capital out there and we have so many projects that need to be done, that's represented by ecosystem services or the benefits of these projects, what's the missing middle? How do we connect the two here? And what we realized is it really comes down to three things. First is the evaluation of the benefits, which means we have to be able to project what those benefits are going to be on the front end, but then credibly verify and measure those in a way that stakeholders will appreciate that and they'll understand it. And then you take that as the next step and bring it into innovative contracts. Can we take some of those measurements and actually build a contract around them that allows the beneficiaries to pay for the benefits that they're receiving? And what we found is stakeholders at all levels like to use different mechanisms. So with a local utility, it's a payment for services contract. With the state government, it's a reimbursable grants agreement. And with the Forest Service here in the United States, it's a cooperative agreement, specifically a stewardship agreement that's used. So we do have different types of contracts, but that really is just us saying to the stakeholders, tell us how you'd like to interact with this. How can you financially support this? What works for you as opposed to us being more prescriptive? And I think that was really helpful. The last piece of this is the financial vehicle, and this is what trips a lot of people up. But all we're trying to do with this is we created a pass-through entity, which you'll see in the structure chart, and this starts to really look and feel like an infrastructure investment or a project finance investment. And that's our goal. This is new, it's innovative, it's cool, or I hope you think so. But what we really want to do is get this to boring, because when it's boring, that's when investors from pension plans and insurance companies, which in the state of California have north of $5 trillion in assets, that's when they start to make investments at a larger scale. And that can get us to the scale we need to be operating at to really solve this problem. So I want to take you quickly through how the FRB works. This is our roadmap. So starting with the project in the Tahoe National Forest, we're working directly with the U.S. Forest Service and then a state conservancy called the Sierra Nevada Conservancy that was dictating part of the state's policy or strategy for restoration. And we talked to them and said, who else might be interested in where do we have projects where you have high capacity implementers, high priority projects, and downstream beneficiaries that would likely take place? They suggest this project. We start working with each of the beneficiaries, which now includes this water and electric utility that's also a flood control district, to understand what the metrics of success for them might be. And that could be as simple as acres restored, or it could be related to water outcomes or carbon outcomes or something of the like. We spent about a year working with those groups to get them to the point of developing the contracts and being ready to sign the contracts. And that took a long time the first time through, but the nice thing is we've developed that framework or that platform, however you want to call it, where we can pretty quickly replicate this as we get stakeholders on board for our second cohort of pilot projects. So it's not until, and this goes back to the governance that I mentioned, not until beneficiaries sign the contracts that we start engaging the investors. And again, this makes sure that the investors don't have any say as to what's happening on the ground or where the project's happening. As they provide the upfront capital, we pass that along to our implementation partners. Again, these are nonprofit entities that have a relationship with the Forest Service. They're designated by the Forest Service to be the project manager. They carry out the restoration activities, and then our independent evaluators, which are academic institutions, measure the success. As that's reported back to the beneficiaries, they make their payments, and ultimately investors are repaid. So my last section here, and this will be relatively quick, is our first pilot project on the Tahoe National Forest called the Yuba project. So as a quick overview, I want to hit some of the highlights here. So this is in the Yuba River Ranger District of the Tahoe National Forest, sort of northwest corner for folks that are familiar there. And what we're doing for a project, again, it goes back to that idea of primarily fuels reduction, but there's also a tremendous amount of meadow restoration, invasive species management, and actually aspen regeneration, where the aspen population has been pushed out by conifers. So some of those conifers will come out and they'll actually start to regrow some of these aspens in the aspen clones. The size of the project, it's designed to protect a 15,000 acre area with about 7,000 acres of treatment there. And then the total project cost here is $4.6 million. We raised $4 million in the form of a forest resilience bond. And the difference there is an in-kind contribution from the Forest Service, both in timber value and in employee time. So again, an in-kind contribution there. In our stakeholders or payers here, we have two state entities from the state of California, CAL FIRE, our Department of Forestry and Fire Prevention, and the Sierra Nevada Conservancy. There's also the Yuba Water Agency, which is that group that's the combined water and electric utility and flood control district, and then obviously the Forest Service as well. So to orient folks, you've got a map of California on the left, you've got a map of the Tahoe National Forest on the right, and you can see Lake Tahoe down in the lower right corner, and then our project area is outlined in red. And this is what's going to be happening in the project. We've talked about some of these prescriptions. As you can see, it's heavily weighted towards thinning and prescribed fire. And again, the goal there is to be able to safely rejuvenate the natural fire cycle that should exist in this ecosystem. But there's also, as I mentioned, a handful of meadow restoration and aspen work as a part of this project as well. Excuse my language, but this slide was sort of the oh shit moment for the utilities as we presented it. And this is fire data from the U.S. Forest Service Large Fire Simulator. And what we looked at here was, what is the chance that a large fire will escape containment? And we wanted to use a timescale that actually would make sense to utilities. They probably think in longer intervals than 30 years, but over the next 30 years, there's a 60% or greater chance that a large fire will hit this watershed and will escape containment, becoming a large damaging fire. And our goal here really across this 240,000 acre watershed is to say, yes, we're starting with a small pilot project here to really figure out how this mechanism works. But the goal is actually to restore the entire watershed. And part of our strategy from the Blue Forest conservation standpoint is to see the number of pilot projects in critical watersheds where if they're successful, they can expand with the same stakeholders, the same contracts, more or less the same investors to really reach scale. And that will happen on a 2 or 3 year time delay. So we're already talking about a larger project down at this part of the watershed, if you guys can see my mouse. So here's the flow of funds. You can see, again, somewhat complicated here. We do set up a pass-through entity for each one of these projects, and that FRB Yuba Project 1 you see there in the middle, it's just a California LLC. It can enter into loan agreements and contracts. There's a pretty restrictive operating agreement, but it does not have any staff. And again, that's because it's just a pass-through entity. So I'm going to walk you through with a numerical example quickly. So starting with the investors, they provide a $4 million loan commitment. It's done on a delayed draw basis because you could not take $4 million and spend it all in one work season. It will take us about 4 years to fully implement this project. As needed, we pass that funding along to the National Forest Foundation in the form of a 0% interest rate loan and also grants. And I know that sounds crazy, but we'll come back to it in just a moment. And then the National Forest Foundation actually is the one that manages the project on the ground. They hire the contractors and ensure that the work is done right. And what allows them to do that is what's called a stewardship agreement with the Forest Service. It's a type of cooperative agreement that allows the National Forest Foundation, which, by the way, is the congressionally chartered nonprofit partner of the Forest Service, to do this work on the landscape. It authorizes them to contract for it, and there can also be funding passed through that relationship. Now, one of the things I mentioned was that we're loaning them money at 0%, and I'm sure that sounds crazy. But the reason that we're doing that is because the state of California chooses to participate in reimbursable grants. And one of the things that we've seen in the state of California is that there's been a huge working capital issue with these grants, meaning that either nonprofit organizations that receive them have a little bit of cash, they spend the cash, they have to wait to get paid back, they spend it again, and by the time they get paid back, your work season has ended and it's really hard to expend all those grant funds. The other way this could work is you just go out and hire the contractors, but you pay them on a 6-month delay. So those contractors, and that could be a really hard way to run your business, especially if you're a small local business. So we provide to the National Forest Foundation financial flexibility to pay contractors on time and do more of this work up front. And then as they receive those reimbursements on the grant, they pass that back to us in the form of a loan agreement. And it's important to note that they are not allowed to pay interest with those grant funds, which was one of the main reasons why we structured that loan at 0%. And what allows us to do that is the last piece here, which is a service contract with a Yuba Water Agency, where they're going to be paying $1.5 million over the course of 5 years. So investors put in $4 million. The The state of California is putting in $2.85 million that will eventually come back as reimbursement. And then we have $1.5 million coming back from the Yuba Water Agency. And that's what creates the return to investors. To see that a little bit more simply, I have a slide coming up in just a moment that will say what part of the repayment comes from what stakeholders. But the role of the implementation partner to us was a really interesting learning as we went through this process, where this really doesn't have a financial need. It's really much more of an operational need. So you have someone that actually knows how to implement these projects. They're trusted. We allow the Forest Service to pick whoever they want, whether it's the National Forest Foundation or the Wild Turkey Federation or any of the other organizations out there that are high capacity implementation partners. It also creates that governance firewall that I talked about. And it's a good financial intermediary because sometimes state and federal entities cannot interact directly with an LLC. They may need to, by statute, interact with a nonprofit entity. So sources of repayment, I know this is a little bit crude. We cannot use state or federal contributions to pay interest, so we use the utility contract to cover that and some of the principal, and you can see how that comes together. And then last year, we talked about who are our project investors. So again, we raised $4 million, $1 million from each one of these investors. 2 of these investors are U.S. foundations, the Rockefeller Foundation and the Gordon and Betty Moore Foundation, and they are doing what's called a program-related investment, which I'm sure folks are familiar with. Their stated rate of return is 1%, so that's clearly a concessionary return for those PRI investors. And then on the other side, we have Calvert Impact Capital and AAA Insurance. And obviously Calvert's one of probably the most respected fixed income impact investors in the whole world. In AAA, on the totally other side of the spectrum, I don't think they'd heard of conservation finance or impact investing, but it made sense to them because as an insurance company, something where they can earn a market rate of return and reduce risk of catastrophic wildfire and get a nice checkbox from the regulator here in the state of California, that's a really good thing for them. So those investors earn a 50 basis point commitment fee and a 4% rate of return on drawn capital. And we actually have all of those investors are pari passu and on the same loan agreement, just with different rates of return. The last piece of this that I think is also quite cool is that you heard that we have an LLC, but everybody's a lender. Well, it turns out that our nonprofit is actually the equity investor and the equity owner of this LLC, which is an interesting relationship, meaning that that's our in-kind fee, and we don't get that money until after all of the loans have been paid off and all the stakeholders have made all their payments and thus are happy with the project. So I will pause there. I feel like maybe I've gone 5 minutes over or so, but I'd love to open it up to questions, and thanks so much for your time, everybody.
Zach, thank you so much. What a fascinating and relatively complex finance tool that you guys have developed here. And I just want to, before we get into questions, want to commend you on being able to design and implement this. And clearly, with all the stakeholders involved, it's quite an orchestration to pull it all together. So, and from my understanding and from what you said, now that you've done it once, it's created, you have all the mechanisms in place and a lot of the partners, and you'll be able to expand in that Tahoe area, but also really appreciate you sharing your experience and learning with us, because it's be great to try to implement some of these things overseas in some of the countries that our members are active in. So so I'd like to open up again, congratulations on this, and so open up to questions, and what you can do is you can write your question into the chat box, or if you're ready to ask directly, you can just unmute your microphone, and as long as not everyone unmutes at the same time, we'll be able to address your questions one at a time. So
and I'm going to stop sharing if that works for you, David, so I can see some of the questions as they get written in here as well.
Perfect. Okay, great. Okay, well, so I have a question to start things off while people are thinking, because it's quite a lot to digest. Obviously, you'd mentioned that you'd received some grant funding to start this, and the in-kind support of these legal firms, and I mean, so in a way, what you're looking at here is a blended finance deal. And in fact, it is blended in the way you're with the investors as well, because you have concessionary loans. So, what have you kind of looked at what the return for you guys might be on this, for you and your grantees might be for this first phase, and how that's going to improve over time, and what your sort of expectations are of kind of profitability going forward?
Yeah, that's a great question. And I think in a lot of ways, what we wanted to do was, whether we were a for-profit entity or a non-profit entity, we wanted to be financially sustainable. And I think this mechanism, we did not take a fee for putting this first deal together. We had about $2 million of investment in the form of PRIs from those foundations, and both had contributed about $1.5 million to get this project to where it is right now. So it didn't feel like the right thing to take a fee from them as we closed the first one, but we will do that in the future. But also this piece of really aligning the incentives and being the equity owner of these LLCs, and we'll use a separate LLC for each project that we do going forward. So in a lot of ways, our nonprofit becomes a holding company. If these projects perform well, we at the nonprofit level will receive more money, and then we can go out and implement our mission without needing grant funds in the future. So we're actually currently doing a fundraising round, and we see it as being able to hit financial sustainability by 2023, 2024, as we start to do more of these projects. But I think the bigger question behind what you're asking there, David, which I'd love to just spend a moment on, is the idea of what type of capital is required at what point in the process. So from our perspective, it was incredibly valuable to bring on private philanthropic capital at the front end of the process. We probably wouldn't have been able to get any government grants without at least some traction, proof points, partnerships, et cetera. And had we taken on private investor dollars instead of grant capital, that might have forced us to push too hard on partnerships early on, or do the wrong project just because it was the first one that came up and we'd have to show our investors something. So in a lot of ways, I'm incredibly thankful to have that grant capital to give us the time and the flexibility to figure out, how are we going to do this, to build out the partnerships, to get all the pieces in place that we're really going to need to be successful here. And then the next part of capital you can touch on are the program-related investments. And again, that's a tool we use here in the United States that allows foundations to count their program-related investments as part of their annual 5% giving, but they actually get that money back if the investment works out, so then they can give it out again in the future. Again, that only exists with US foundations here, but that's a great tool to test a concept, to get your proof of concept using that type of money. And then our thought process was initially that we'd likely have groups like family offices as initial investors before getting larger projects together where we could actually tap institutional capital like pension plans and insurance companies. But lo and behold, in this first structure, we actually ended up with a small to mid-sized insurance company with AAA. They manage about $9 billion. That's a lot bigger of an investor than I thought we were going to have the first time we did this. And the insurance side was really eye-opening to me, that it's just so well aligned, market rate of return, checkbox from the regulator, and ultimately, as this scales, decreasing fire risk in areas that they have actuarial risk on the books. So it worked out really well from that standpoint. But I think that sequencing of capital, sort of grants to develop, PRIs to test, and then stepping up with different types of investors as the size of the opportunity starts to grow and emerge.
Yeah, excellent insight and information. All right, so we're gonna move to some of these questions here. The first one comes from caller number 4, mystery caller. What are the ecosystem services being valued, measured, and paid for? I think you alluded to water, but yeah.
Yeah, so most of what we're measuring is on the water and the carbon side for the first project. But in a lot of ways, every ecosystem and every watershed is different. So the watershed we're working on has pretty solid bedrock underneath it, so you don't get tons of sedimentation issues. We do have some flooding issues, so you can measure avoided flooding risk, avoided sedimentation. In this case, we're actually looking at enhancement in water quantity that's available because we're reducing the amount of vegetation on the landscape. And only in certain places, I think the western slope of the Sierra is one of those very few, you could actually see an increase in water quantity coming through a watershed. You might not, but that's why you use things like performance-based contracts. If it doesn't come out, the utility shouldn't have to pay for it. On the carbon side, there's clearly carbon credits. We are not allowed to produce any of those because we're working on federal land, and that's not a landscape that you can use carbon credits on. But we have seen some really interesting methodologies around avoided carbon emissions. So even though you're reducing vegetation, in this case, you're also reducing the risk of a catastrophic wildfire and then reducing those emissions down the road as well. And that's a relatively new methodology. It's something we'll report on, but there's not really a payment tied to it. Another thing we'll do in our annual impact report, we'll be talking about job creation, how many people hours are worked in the forest, and both direct and indirect jobs that might come from that. And I think when people think about ecosystem services, they almost exclusively focus on the environmental benefits, but we should treat these social benefits as an ecosystem service as well.
Well, that leads right into the next question, which was from Christine. I don't know, Christine, if you want to ask it yourself, or are you happy for me to read it? But I'll start. Just jump in if you'd like to. But she's saying, thank you for the presentation. You mentioned in the presentation that some of the outcomes were improved economic opportunities for these local rural communities. And so how do they get involved? Since your example was purely based on environmental outcomes, and are there grants programs alongside of this to support this?
Yeah, there are definitely some grant programs, and there's a number of NGOs in the state of California. For anyone who works here, I think about a group like maybe the Sierra Business Council, for instance, that actually works with local communities and starts to train folks to do this type of forest restoration work. Again, we have huge unemployment issues, in large part because we had a ton of mill infrastructure and bioenergy infrastructure in California 30 or 40 years ago. And a lot of that has gone by the wayside and has gone out of business over the last few decades. So people that would otherwise be working in that industry have lost their jobs. So one thing we can do here is create the direct jobs in terms of doing some of these restoration activities on the ground, but also when you think about you're removing some of this vegetation, this is not merchantable timber in most cases. What's often done is it's put in a pile and burned, which is a crazy thing to think about, but that's one way to reduce the fire risk. Well, what if we could move those piles and do something of greater value, create bioenergy, create oriented strand board, press board, the things that IKEA products are made out of. This is softwood species, so not really great from building from that standpoint, but there has to be something better to do with this than just put it in a pile and burn it. And I think to me, that's a big rural development opportunity, because it's tons and tons and tons and hundreds of tons and thousands of tons and millions of tons as you start to increase the scale of vegetation that really does need to come off the landscape so that we can reduce the risk of catastrophic wildfire. And again, this is not really merchantable timber for the most part. It's small diameter trees that again would have naturally been taken out by fire. So I think that's a really big opportunity. We don't make a bet on what technology or what is going to be the big driver in terms of employment. I think there's going to be a lot of different local groups that will try different things, and we'll see what works, and we'll try to support any of those groups as best we can. Back to the grant programs, there definitely are some. I'd love to see more. We've had our state forest health grant program in California jump from about $20 million a year to $200 million a year. And that's set to stay at that level for the next 5 years per the last governor and our new governor. And I'd love to see more of that money spent on workforce development and training programs. And I think that would be incredibly valuable for the state of California. So thanks for that question.
Thanks. And there's a question from Ian here. He says, good morning. Do you foresee difficulties attracting investors if federal funds rate increases? So if the interest rate increases, in other words, how much value do you think as potential for-profit investors see in this in the impact portion of the investments versus return on investment in dollar terms? So how much are they going into this for the impact versus return?
It all depends on the investors. Clearly, the foundations that we're talking about here that are making these concessionary investments, so they're actually earning less than the Fed funds rate in an investment like this, they're doing this for the impact. And I think it's probably not worth spending too much more time on them as a type of investor, because there is a limited amount of this funding out there. I'd guess it's a couple $100 million a year that goes through this way. So we could tap into that for a number of years without really reaching that scale. But it is not the same as tapping into commercial market rate investors. And it also may be less applicable to other folks on the phone. So I'm going to push that to the side and talk about the two investors that we worked with here. For folks that know Calvert Impact Capital, they do some of the best due diligence in the business. They are definitely an impact investor, and they would describe themselves as such, but they do not sacrifice financial returns. And they've been a leading investor in a number of environmental impact bonds like this, including the DC water bond that was put together by Quantified Ventures. It was them and Goldman Sachs as investors there. So they're definitely an impact investor. And on the flip side, the insurance company didn't know what impact investing was really. Sure, they've heard of it, but they don't do it. They don't actively practice it. And it just made a lot of sense from their standpoint that this would be a market rate of return. And I'll talk about that in a second. But that additional benefit of getting a checkbox from your regulator and ultimately and eventually starting to reduce the risk of catastrophic wildfire is also really important to the insurance companies. We actually worked with the Department of Insurance over the last 6 months here in the state of California to get this investment certified on the California Organized Investment Network that they run. That used to come with a tax credit. I don't know if it still does necessarily for the insurance companies, but basically the regulator has said this is a safe and sound investment. It's socially impactful and environmentally impactful as well. And again, that's a small network. I mean, it's about $4.25 trillion of insurance assets. I think only about $25 billion go through that platform. But that's a lot of money, and that's enough money to solve this entire problem, frankly. So from that standpoint, it's really a scale issue, I think. As we're talking about interest rates, I did a lot of structured finance. I worked as a bond trader, so this is something I could talk about for a long, long, long time. I'll try to be brief here. So the way I look at it, yeah, Fed funds moved a ton from when we started this project. My first financial model, I think the Fed funds rate was still under 1% when we were building this out. So that definitely caused us to finance this at, I thought we'd get this off at 3% when we first started talking about it, and then the move in interest rates certainly made 3% look a lot less attractive initially. But when you think about it, any dollars coming from the Forest Service are appropriated funds that are obligated. The reimbursable state grant program, while there is operational risk, that money is also encumbered by the state government. So your only real credit risk here is the water utility that's paying out of its operating budget over the course of the next 5 years. That water utility is AA+ rated, and they're actually rated just on their water sales. They took over a hydropower installation in 2016 from PG&E, and they tripled their revenues without really increasing cost in too much in a real significant way. So they've actually improved as a credit from AA+. They just haven't had the opportunity to issue debt or be re-rated. So the credit risk is really minimal here. So when you look at this and you say, okay, you're picking up 175 basis points over the 2-year, that to me starts to make a lot of sense from an investor standpoint. Again, remember, the weighted average life as calculated of this is inside 2.5 years, but really it's shorter than that because I'm only drawing capital bit by bit as we use it. In most circumstances, our expectation is we'd only have investor capital outstanding for about a 12-month period. So in a lot of ways, it's shorter than you think it is. Legal final is 5 years, but weighted average life is much shorter than that. And when you comp it to either 2-year or 5-year treasuries, and we actually have an inversion right now at that point in the curve in the United States, you are picking up 175 to 200 basis points as compared to that, which I think is pretty attractive to investors at this point, especially for something short duration like this.
All right, great. Dan Sokol, you had a couple of questions. If you unmute yourself, you're on.
I did. Thanks, David. Thanks, Zach. Really, really interesting. You've answered one question, so there's only one left. I'm interested about the insurance side, and you've kind of answered it already, but we've been trying to engage the insurance sector over here in the UK for similar things, but from a flood risk perspective, on perhaps the naive assumption that there would be interest in investing to mitigate flooding because it would reduce the underwriting risk held by those insurers. Even a guy who classes himself as one of the wackier people in mainstream insurance over here, who loves the idea, has said you'll find that difficult because insurers work on a year-to-year basis, and frankly they're reactive and they will just reprice the risk. Basically saying there isn't really a vested interest in reducing underwriting risk because they just reprice it. So I just wanted to check. You talked about AAA insurance having an interest in reducing their underwriting risk. And I'm interested what's behind that, because I can't imagine insurance is particularly different across the pond, and I'm interested in what's different and why there was that interest, because they could quite easily just reprice any risk. Now, at some point that will break down because you can't reprice in risk forever, because as risk goes up, we get to a point where the bubble bursts, but we're perhaps not there at the moment. So I wonder if you can just kind of eke that one out a bit more for me?
Yeah, absolutely. And for better or worse, we are now there for wildfire risk in California. I go to a lot of insurance convenings to listen, especially on the actuarial side, where I have a finance background, but certainly not an actuarial or liability management background. But what we've seen is that there's been such a dramatic increase in fire risk over the last 5 to 10 years in California. It's gotten to the point where that bubble has burst. There's only so much you can raise rates, and we're getting to the point where there's mass cancellations of policies in California, which again sort of furthers some of the challenges for these rural communities. You can't get a mortgage if you can't get insurance on your home, and you're in a high hazard area. So there's going to be a lot of work and money spent on things like home hardening. A lot of times when these homes are burned down, it's not a wave of fire that comes through and burns everything, although that was the case in Paradise. It's often embers that are flying a couple miles ahead of the fire that will get into the pine needles underneath your wooden deck, and then pretty quickly your whole house is on fire. So they're going to do some things to try to address that, but realistically, we're at that point where the bubble was burst. Now, everyone asks us, why aren't your insurance companies the payors, right? Why aren't they the ones paying into the structure? Why are they the investor instead? And one of the things we've realized from that, and talking to a lot of insurance companies, is that in these rural areas, it's relatively diffuse in terms of land ownership, a lot of private land sort of interspersed in there. And really different types of communities. Some are very expensive homes, some are, sort of the lowest income areas in the state of California. And what we realize is there's not always an insurable mass in and around where these projects are happening. And even if there was, often, you may have State Farm, I may have Farmers, somebody may have something else. They don't have the insurable mass of any one entity, with the exception of USAA, if folks are familiar with them. They sort of gear themselves more to a veteran population. So you actually do get pockets of veterans that live together in ex-urban settings. So that's sort of the best case. And they've actually worked on a FireWise program where they give their members discounts for doing work like defensible space, keeping 100 yards of clear space around your home, moving your firewood outside your home, things of that nature. But that was a real eye-opener for me, because again and again and again, I always hear, well, why are insurance companies your investors and not your payors? And I think that's the main reason for it. And again, I'm not an insurance expert. I will tell you this, I think where this has gotten more visibility, more interest on the insurance side is actually with reinsurers. So they're the ones that tend to look well beyond a year. They look out 30 years or 50 years longer. And I would imagine some of the best climate models outside of the scientific community are actually probably with some of these reinsurers. So I think that's a new and interesting area for us to engage somewhat. But again, we've gotten to the point where I don't even think you could price a cat bond or some other insurance-linked product to do wildfire risk reduction in California. It'd be interesting to see if something like that comes out of a, PG&E bankruptcy. I don't know, but so there could be some other products that might work like that. I think this is probably more efficient from a financing standpoint than a cat bond would be, given the risk transfer and how that happens with a financial instrument like that. So I think the point is there's a larger conversation to have, but I think it's easier to bring them to the table as investors and can be a great source of capital to fund these projects because they're aligned from an incentive standpoint, even if they're not putting new money into the projects as a beneficiary.
Okay, that makes sense. And there's a couple of things that you said there that chime quite well. One of the problems with going to the insurance sector is that if they do successfully reduce risk, then all other insurance companies can take the benefit because they can just lower their price and capture that part of the market. The other thing that did come up just for interest is, whilst insurance is part of it, mortgage lenders is another part, and specifically around flooding, because if we see the incidence of flooding rising and you might get this with fire, then there's mortgage lenders that are holding all of these assets, are watching those assets value and potentially losing money. So that's another area that we're kind of looking at as well. But anyway, thank you for that. That does explain something for me.
Excellent. Great.
Thanks, Dan. So we're running short on time here, Zach, but maybe you can hit these next two questions together. So one is a question of consequences for investors. This is from Douglas, if there's some sort of ecological damage or inappropriate activities, and the other is just asking about general risks to the investors. What happens if the outcomes are not achieved?
Right. Absolutely. Well, I'll start with the ecological question first. And again, I should preface this by saying I'm not an ecologist, but we work with many very, very smart ones. So one of the nice things about working in the United States as opposed to in developing countries is the strong rule of law and the strong enforcement of those laws. So in order to cut down the first tree, start the first prescribed burn, remove the first logging road, you have to go through the entire NEPA process, which is the National Environmental Policy Act. I don't want to take too long to explain the whole process, but often you're talking about 18 months to 2 years of planning activities to make sure that the environmental impacts are as intended on the landscape. And what we're doing right now, for instance, in the Tahoe project, is the Forest Service has led research into the historical range of variability. What did vegetation look like, not just in the last 150 years where we have good records, but go do the dendro and see what it looked like for the 500 years before that. So they've basically gotten a better understanding of how our forests have changed over time and what a healthy natural state would look like, especially when you start to look at the fact that there's an expectation that our forests will be 9 degrees Fahrenheit warmer by 2100, which is a really crazy thing to think about from that standpoint. This is also a process where the public is involved. So the public has the opportunity to both comment and object on any of these projects, and there's a long lead time that allows them to do that. So by the time this project has gone through this process, and then an entirely separate environmental permitting process in the state of California that has different species, protected species, et cetera, you'll have things like for protected activity centers for owls. People will have to physically stand in the woods and listen for a set amount of time to make sure there are no owls or we're not touching that area where they exist. So in a lot of ways, there's incredibly strong laws around what has to happen here in the United States, and especially in California. And our investors don't get involved until after that has already taken place. And then when you think about it from the contractor side, we've created an incentive where the manager is a nonprofit, so there couldn't be any sort of kickbacks or anything like that happening. And the contractors don't get paid unless they do the work the right way. And part of what we're paying for is actually consulting foresters to go walk the forest and make sure you're leaving the trees that you're supposed to, you're taking what you're supposed to, and you're actually implementing the prescriptions as the Forest Service, the land manager here, wanted you to. So in a lot of ways, I think if you were just raising a fund to go do this, the risk actually from investors would be that this process would just take too long going through the environmental permitting. So in a lot of ways, it's much better that they come in after the fact. And again, that alleviates the governance concerns of them trying to dictate what happens on the landscape. In terms of the second question here, it all depends on the structure. So actually in this first project, we had all of our beneficiaries making fixed payments. So there really isn't any risk to investors about specific outcomes. And one of the reasons we did that, we actually put both a pay for performance contract and a simple payment for services contract in front of the utility and said, hey, we could make this payment and we could shift your payment each year based on some of the outcomes, just to be a little bit. So we proposed they're making a $300,000 payment. If we have a really low output from the water side, they'd pay $25,000 less. And if we had a really high outcome, they'd pay $25,000 more. So at the end of the day, the majority of that payment would have been fixed in either case. What the water utility decided in this case was just to keep a fixed payment, but we are contractually obligated to measure those outcomes and report it back to them. And they in the future can decide, hey, do we want to use a performance-based contract on something like this or do we not? And again, those performance elements, if sedimentation was a big risk in this watershed, it could be on sedimentation. We could get people paying for avoided carbon emissions if they so desire to. It really just depends on how you structure those contracts with the stakeholders. And again, we focused on, at least for this initial one, more of a fixed cost, pay for the acres as they're restored, because we know there's so much value in doing that type of work. So I'll pause there because I know I'm now a couple minutes over. But thank you all for the questions. This was wonderful, and I'm happy to stay on if folks want to, but I want to turn it back over to David now, and just thank you again for the opportunity.
Well, Zach, thank you so much. I think I just put into the text box a link to CPIC, to CPIC, where there's a blueprint on the forest restoration bond. And so there's more information there that you can read. Also on the website, we had one question, and then I'm just noticing that Douglas is saying that he's not sure that I came on, but so let's maybe officially close it, and then anyone who wants to stay on, Zach, if you're willing to continue to answer questions, obviously there's lots of interest in this. Let's stay on and continue discussing. So why don't we, let's see if you can respond to
yeah, the blueprint link. There you go. Yeah. So you can find the blueprint on forestresilienceBond.com, and we did that because we didn't really want this stuff to be all about us. We wanted this to be about the partners. So from that standpoint, we can sort of get everybody under this same banner here. And we've got a report that we wrote up for the Rockefeller Foundation back sort of towards the end of 2016. So slightly dated, the mechanism turned out to be a little bit different, but you can find some more resources, and there's a great, and about 2.5 minute, like how it works video. That's pretty quick and easy to get to.
Great. Yeah. So okay. I'm sorry. I did not send that to everyone, but Zach, I think you just did. So there's a link to that for everyone. We had one more question, and then we can get back to Douglas because you were unsatisfied with the response there. There's a question from Sam Rudick here on trying to find it.
Oh, credit, I see there. Yeah, credit enhancement. Yeah, this is a good question. So I think in a lot of ways we've tapped into as cheap a set of capital as we can with these program-related investments at 1%, and then treasuries plus 175 or so on the other rate of capital. There are other programs. We have block grant programs from the EPA called State Clean Water Revolving Funds that you can tap into, anything from 0% to AAA or sort of government funding level. From that standpoint, we could bring that in. And I think there may be an opportunity for credit enhancement in the future, but if we didn't need it with this first one, and again, we are sort of the equity owner, so in some ways, our fee is the credit enhancement for the structure. We structure a little bit of excess cash flow, and there's not much in this one. But if some parts of this don't work out, that money goes first to the investors before any of that would go to us. So in some ways, the fee is kind of credit enhancement. And since we didn't need a credit enhancement grant or a guarantee in this first project, I'm hopeful we won't need it in the larger projects. But I guess in some ways that's still TBD. But good question, and thank you for that.
Thanks, Zach. And then just getting back to Douglas here, is do you want to
see how that answered my question? Yeah. Well, if not, I can point you to some resources, Douglas. Again, as I mentioned, I'm not an ecologist here, but the general technical reports that the Forest Service put together are the documents, and they're specific to not every single forest, but basically every landscape. So you'll have documents for the western slope of the Sierra Nevada as to what a forest should look like. And that's how the prescriptions are devised. And that's what goes to again, the National Environmental Policy Act that dictates what can be done and what can't be done on the landscape. Protection from an investor standpoint, I guess in some ways, my thought process there would be, if the contractors don't do the work they're supposed to do, they don't get paid. So we would never draw the money from the investors to pay them anyway. But that's why you have things like consulting foresters overseeing this work as it's taking place to ensure things like that don't happen. And again, I know this is very different than working in more developing countries where you see tons of things like illegal logging taking place and issues like that. Frankly, that's really not the case here in California. So I'm not totally sure how to better answer that question, but we do have a lot of resources if you're interested in reading more about forest health conditions in the West, how we've gotten so far from a normal, nice, heterogeneous forest that has different species, different ages, different spacing of those species, and then how we can get it back to really what it should look like for proper ecological function. And again, I would probably defer to an ecologist or a forester to dig into more detail with you if you'd like.
Okay, thanks, Zach. Really interesting, getting lots of thank yous as people head out. So I think we'll end it there. And again, thank you so much. Thanks everyone for joining. And we look forward to seeing you at the next webinar, and get in touch with us if you have further questions. Again, thank you so much, Zach. Really appreciate it.
Great. Thank you all. Have a good one. Bye-bye.
All right, thanks. Bye.